This business about GoldBach levels.
In this video, I'm going to go through some important foundational principles that you must understand in order to become a professional trader who is consistently profitable. Now, I'm not going to talk about every single aspect of mindset, but these are two very critical concepts that you must understand. Now, the issue a lot of traders have, and something I had in my own personal trading journey, was that I would learn a trading strategy. And then, just by chance, if I were to win 3 winning trades in a row and then suffer my first loss, I would think that the strategy is broken. And I would either try to tweak the strategy or I would go look for a new strategy. Right? But this is definitely the wrong approach, right? In terms of trading, we have to think with a probabilistic mindset. We have to ignore the individual outcomes of a trade. Whether your last trade is a winner or a loser does not matter. That does not factor into your professional mindset. Instead, you have to think about your trading over a series of 10, 20, or 30 trades. This will allow your edge to play out. So let me exemplify this. Imagine if you had a coin, a fair coin, that has heads on one side and tails on the other side. And if I asked you to flip that coin 4 times and I asked you to predict how many heads you would get, the majority of you would predict 2 heads out of the 4 flips. But it is possible that after flipping the coin 4 times, it actually hits tails 4 times in a row. That's how we have to understand trading. If, however, you were to flip that same coin 1,000 times, it's likely you'd get closer to 500 heads and 500 tails. This is exactly how we have to think about trading. We cannot think about the individual streaks of wins and losses and conclude that is the result or the effectiveness of our trading strategy. Instead, we must reduce the risk and have it at an acceptable level so that you can ride out those strings of losses, which will happen under any trading system. But as long as you have enough bullets in the chamber, you can then be consistently profitable overall. This is the key. So what I would like to direct you to is Mark Douglas's book, Trading in the Zone. Within this lecture series, if you go to the mindset chapter, there are also some lectures from Mark Douglas there. Right, Mark Douglas has some amazing gems in there, but I think the biggest takeaway is you have to get to a level where you ignore the individual outcomes of a trade, right? Because it doesn't matter what your trading strategy is. So let's say the golden bullet does give you an entry and you are holding the trade and it looks like an A+ setup and then you stop loss. It does not mean that strategy is broken. Right? The market and the algorithms that are run are complicated. Even though a particular algorithm is running, such as the golden bullet, another algorithm may take over. Maybe a higher time frame algorithm or even a time-based algorithm. For that reason, you cannot bet 100% of your account on one trade. You bet a small enough amount so that you can ride out those random losses that you have and allow you to be consistently profitable over the long term. So what I recommend you do in order for your edge to play out, if you are doing something like a funded challenge where you have a 10% drawdown, I recommend you only risk 0.5% per trade. That gives you 20 consecutive losses to pass this challenge, right? Even if you have 4 or 5 losses in a row, that shouldn't affect you too much mentally, because in the grand scheme of things, that's not going to dig you such a hole that you can't get out of. But you'll be able to weather that string of losses, and then when your edge starts playing out, you can then be consistently profitable over the long term. This is key. Now, the second concept is ensuring you understand that this game is all about asynchronous steady returns over the long term. Now, what does this mean? The problem with social media is that typically the trades that get all the eyeballs and all the clicks and that go viral are the 40 RR trades, the 20 RR trades, the 10 RR trades, right? And that sets unrealistic expectations that as a professional trader, this is what we can do. You take one trade, risk $100, and then it's 100-to-1 trade and you can buy a car at the end of it. It doesn't work like that, unfortunately. What I learned from analyzing top traders in the industry was you have to have a strategy that is basically a delicate dance between the win rate and the RR to be consistently profitable over the long term, right? And I really internalized this when I analyzed Paladin and JadeCap's trading history. So if you look at Paladin's trades, which may not be publicly available anymore, over the series of trades that I analyzed, his average RR was 2. Not 40, not 20, not 10. He always TP'd at 2 RR, and his win rate was 50%. Right? A 50% win rate with a 2 RR strategy is wildly profitable. Right? We do not need 90% win rate strategies with 10 RR. Right? They just, sadly, I don't think they exist. Right? You just need a slight edge in your favor when combined with the RR makes you consistently profitable over the long term. I also analyzed JadeCap's MyFX book, and over the 99 trades that he took, his average RR was 1.95. And of those 99 trades, his win rate was 62%. Now, 62% and a 1.95 RR strategy is wildly profitable. And JadeCap has taken over $1 million of funded payouts so far. Right? This really helps us to understand what profitable traders are actually achieving. Right? You don't need a wild strategy. And this is exactly how I designed the Golden Bullet. The Golden Bullet is algorithmic in nature. And the TP level that I have set, that you will learn about later in this course, is one that is hit frequently. The RR is a realistic target. It's not a target that's only going to hit 5% of the time, right? It's algorithmically defined to be hit frequently. As long as you have the right entry and it's a golden bullet, right, it will hit frequently. Your job is then just to get to something like a 50% win rate and you are wildly profitable. And I have provided the tools in this course so that you can get there, right? But the key point of this slide is to ignore the outcome of an individual trade and instead log your trades and think about your trading success over 10, 20, or 30 trades. You have to allow your edge to play out. Secondly, it's not about those massive RR wins. It's about incremental gains over the long term with a strategy that has the right delicate dance between win rate and RR to be consistently profitable over the long term and to steadily grow your account. Unfortunately, due to social media, it's very easy to be captivated by those 20 RR trades, 10 RR trades, and claims of 90% hit rates. So I'm showing you JadeCap's MyFX book. So this is 99 trades worth of data that he's made public. And this really drills home what we should be expecting out of any strategy, and also why the golden bullet strategy is set up in the way that it is. In JadeCap's MyFX book, you'll see he has data from the 1st of September to the end of October. So in that period of time, he took 99 trades. So he's roughly taking a trade a day, even less than that. Right now, he has a one shot, one kill strategy, so a trade a day does make sense. We have the Vegas strategy. So as soon as we have our first win for the day, we close our charts. Or if we have 2 losses for the day, we also close our charts. Now, the interesting point of Carl's data is his profit factor, his RR is 1.98. So you see a lot of things on social media where people say their average RR is 5 RR, 10 RR. JadeCap has about $5 million in funding, and he shoots for 1.982 RR per trade. Now, as you know, the standard golden bullet strategy has an RR of 1.93, and the advanced version has an RR of 2.34. So we align with what JadeCap is doing. And if you have a look at his win rate, so he took 99 trades, and of those trades, he won 50% of his longs and 72% of his shorts. And when you average out his 63 wins over his 99 trades, you get to a win ratio of 63.6%. So this is what we're really shooting for, to be extremely profitable. If you have an RR of 2 and a win rate of 63%, it's just a matter of time until you could potentially manage the type of capital JCap does. Now, don't be disheartened if your win rate is 50% right now with the golden bullet. 50% win rate, as you would have seen in my Monte Carlo simulation video, is still wildly profitable. But as you start refining your edge and as you start understanding which ICT confluences you really like to increase your probabilities, it's just a matter of time and logging your data until you get to similar numbers to what JCap is achieving. Now, do bear in mind, JCap's been in the game for a good 10 years, and he's refined his edge over a long period of time, and he's very disciplined in how he trades. Very few emotional trades. He doesn't wreck his account if he loses, if he has a losing day. He's very disciplined in his approach. But I just wanted to show you his MyFX book to show you what is realistic, what is happening in the real space from professional traders, and potentially what we should be aiming for. Now, in order to get here, you have to log your trades. It's essential you log your trades and also that you work on your mindset. Let's continue the conversation in the comments section of the Discord. So feel free to let me know your insights, and we can chat about this. In this teaching, I want to use the Monte Carlo simulator to help you understand the power of asynchronous returns. And I'll use the case study of passing a funded challenge using the golden bullet to help you understand what to expect out of the golden bullet and how your returns can potentially increase as you get more proficient in executing the golden bullet. I'll provide a link to the Monte Carlo simulator below, but this is how it's presented to you when you load up the web page. So let's configure this as if we were running a golden bullet. So as you know, for the fundamental version of the golden bullet strategy, we have a 1.93 RR. Now, 1.93 is a theoretical return. Obviously, you have to take into account your own commissions and spreads and fees based on your broker. But 1.93 is what we're going to use. If you are using the advanced version of the golden bullet, then your theoretical return is 2.34 RR per trade. But we'll go with 1.93. And then over time, as you start logging your trades, you can see what number this actually is depending upon your broker fee. So maybe it's, when you put your fees and commissions in, it may be 1.85 or something like that. But we'll use 1.93 so everyone's on the same page. So let's assume a win rate of 50%. And let's take the case study of taking a $100,000 funded challenge. And if we were to risk 1% per trade and then run the simulator for 20 trades. So the great thing is now most funded challenges have no time limit. So before you had to kind of rush, and as you were running out of time, you'd have to increase your risk per trade in order to pass the challenge within 30 days. Now it's a very different time where you can really take as long as you need and wait for your A+ setups and keep your risk constant in order to pass your funded challenges. And we'll keep the number of sequences at 12. So this basically averages out. It just runs the simulator 12 times and averages out the results. Because as you know, with things that are based on probability, even if you're flipping something like a coin, which is technically 50-50, if you flip it 10 times, it may be heads 7 times and it may be tails 3 times. But if you keep running through this exercise, so instead of flipping it 10 times, you flip 10 sets of 10, you should get closer to the true result of 50-50. So this will just average it out, and we'll say we're taking 20 trades during this funded challenge. We're risking 1%. We're starting with $100,000. Our multiple is 1.93. And we'll start with a win rate of 50%. So this is where you understand the golden bullet. You understand that ICT confluence is needed. You haven't yet refined it and understood or ascertained for yourself what an A+ setup is based on the ICT confluences you like. So we're starting with 50% win rate. So if we run the simulation, so after 20 trades of risking 1% with a win rate of 50%, you would have a gain of 9.3%. Now, depending upon the funded challenges you're taking, some have a goal of 8%, some have a goal of 10%. So let's say your goal is 10%, then maybe you would need something like 25 trades to get there. There we go. So if we were doing something like a 25 trade simulation, after 25 trades, your gain would be 13%, which easily passes the funded challenge. And your worst losing streak using this sample of data was 3, and your best winning streak was 4 trades. So this kind of tells you that you can't expect, even if it's a 50-50 strategy, you can't expect every other trade to be a winner and a loser. You will, just because of the odds, you will have streaks of losing trades. As long as you stick to it and keep taking exactly the same setups that you've proven work over the long term, you should be profitable, consistently profitable. But the key thing is, it's about asynchronous returns over the long term. There's a reason why we have a multiple of roughly 2. A lot of prop firms have released data, and they show that the traders who pass challenges have an R multiple of around 1.95. That's what the data shows. And the Golden Bullet has one of 1.93 for the standard Golden Bullet, and the advanced Golden Bullet has a RR multiple of 2.34. Now, let's say you are still learning the Golden Bullet and your win rate isn't so high. The Monte Carlo simulator can help us to understand what is the break-even win rate. So we're less than 50%. And what is our break-even win rate using this strategy? So let's say our win rate was only 36%. We started with $100,000 and we took 25 trades. After those 25 trades, we'll be down 1/3%, which is basically we've broken even. If we just run it again, right, we are at 4%. So it's sometimes you can get lucky and even have a low win rate and win a funded challenge. But yeah, there we go. So break even at roughly a 36% win rate using the multiple of 1.93. Now, as you get more proficient, there's no reason why you can't get to a 60% win rate, right? And if you had a 60% win rate and you only took 20 trades, you would easily pass even a funded challenge that requires a 10% hurdle. Now, let's have a look at the advanced version of the Golden Bullet, where instead of having your stop loss at the low, you have it at the bottom of the order block GB level. RR will be 2.34. Let's say our win rate was 50% and we only took 15 trades. Again, we start with $100,000 and we're risking 1%. 9.2%. So we've almost passed a 10% challenge and we've easily passed an 8% challenge. If we run it again, there we go, we've passed the challenge. So have a play with this tool, just so for yourself you can start understanding where you are. And then while back testing or even forward testing with demo, once you ascertain what your win rate currently is, based on your understanding of the Golden Bullet and the ICT confluences you're using, use your data to pull out your win rate, put it into the Monte Carlo simulator, put in your true RR multiple. So if you're using the standard version of the Golden Bullet, which should give you 1.93, you should be able to calculate exactly what your multiple is. So maybe due to fees and spreads, your multiple becomes 1.85, and then you can simulate challenges without having to take a challenge. And as long as it passes the simulation, on average, then you're free to take a challenge. So, in this particular case, or 15 trades. So if we put it back up to 25 trades, and let's say your multiple is only 1.85 in reality, due to some high commissions from your broker, you gain might only be 6%, so maybe you'll have to take some extra trades. 30 trades. There you go. So you pass an 8% challenge, and you probably need one more trade to pass your 10% challenge. Any questions, feel free to DM in the questions section of the mentorship server.
This business about GoldBach levels.
Now, in this teaching, I'm going to go over the critical concepts that you need to adhere to in order to become a consistently profitable trader. Now, something that I keep reminding myself and my mentorship students is the following phrase. The magic that you are trying to find lies in the work that you are trying to avoid. Now, sadly, once people have a consistently profitable strategy, instead of focusing on that strategy or doing the simple things that they know that professional traders do, if they aren't immediately consistently profitable, they go try finding some new magic. Believe me when I tell you this, the real work is not in the strategy. Once you know the strategy, it's about ensuring that the strategy works and mastering that strategy. And the processes that you need to go through in order to do that lies in these 5 principles that I'm going to teach you today. Now, firstly, the trading plan is critical to your trading, and you'll be surprised at how few traders have a trading plan. And there are a number of reasons why they refuse. The first reason why people don't write down a trading plan is because they have not clearly thought about the entry criteria for their strategy. Right? The reason why we write down a trading plan outside of our trading time on the charts is so that we can very carefully think about all the conditions that must be met in order for us to put on a trade, right? Once you start writing down a trading plan and these questions pop in your head, you will have to find answers to these questions that will require research. Right? But if you are trying to make a decision while on the charts whether or not you should trade because a key aspect is not in your trading plan, you are more likely to make an emotional decision because of the time pressures and the dopamine rush that you want to produce via putting on this trade than using logic. Right? If you write down your trading plan in a relaxed state, if you don't know the answer to why you should trade or not, you can go research it, you can go back test it, right? So the first reason people don't like having a trading plan is because they know they haven't fully decided on their trading criteria. The second reason why a lot of traders don't have a trading plan is because they don't want to stick to a particular trading strategy. Instead, they want to jump on the charts and trade any price action that's in front of them. Right? As a professional trader, you have to develop a specific skill. And for us, it's the golden bullet, and you have to master that skill. Unfortunately, many traders do not see the markets as a business or as a profession. Instead, they use it as entertainment. They use it as a slot machine. Now, the problem with trading is a lot of the skills and general rules you've learned in life do not apply to trading. So in the real world, a lot of people have understood that the harder you work and the more time you spend on something, the better your results are, right? So if you are in sales, the more sales calls you take, the more likely it is for you to hit on something and generate a return. Or if you're someone who goes to the gym, the more sets and the more reps you do, the more likely you are to break down that muscle and build a hypertrophic response. Trading does not work like that, right? A lot of people think that they can sit on the charts all day, and because they are in front of the screens, they are working hard. Instead, trading is about doing the exact amount, no more, no less. That is the skill. And the exact amount is only trading according to your trading plan. Now, I will go through the golden bullet And there will be a teaching on exactly the entry criteria. Please use that and convert it into a trading plan. Because once you have a trading plan, you know exactly what the entry criteria is for your trades, and then all your trades should then be identical. So then when you log your trades in your trading journal, you can assess how close your trading entries were to your original trading plan. And then you can start assessing how you can improve your trading, right? It should be an iterative procedure where you clearly define the trading rules. You then log to see if you are adhering to those rules. And then if necessary, you can tweak your trading plan. So something that I was logging in my trading journal was whether I was executing a trade in my office or my computer setup, or whether I was executing on my mobile phone. I had a feeling that my mobile phone trading performance was not up to par. And after logging a series of trades, I could see that my win rate on my phone was drastically lower than if I was trading from my office. Right? You cannot tweak your trading plan based off of an individual trade or your memories of how you think factors influence your trading. Instead, you need hard data, and your trading journal and statistics are hard data. Again, if we go back to our example of flipping a coin, if you have a fair coin, which has heads on one side and tails on the other, you cannot just flip a coin one time to predict whether over the long term it's going to be a head or a tail, right? Even if you use a sample set of 2, you still may only get 2 heads, not a head and a tail, right? Instead, you have to flip that coin a good 50 times to really understand the dynamics of this coin, right? Similar with your trading. Just because I executed one trade on my mobile phone, which is a winner, I cannot then assume that trading on my phone is optimal. It's only after I had logged some 20, 30 trades on my phone did I realize my performance was suffering compared to my trading in my office, right? Now, that's just one example. There are numerous statistics that you can track in your trading. Something I urge you to do also is when you log the golden bullet, don't log every golden bullet as if it is a golden bullet. If you know you missed entry criteria, right? Or if you know that you FOMO'd into the trade as a market order instead of a limit order, that is not a golden bullet trade. You need to log that as a FOMO trade or an execution error, because otherwise you will then confuse your outcome for your real golden bullet trades and all of your FOMO trades or your execution errors. Now, it's important to log those execution errors also, because if you see that 10% of your trades are execution errors, you can then address that, right? What gets measured gets managed. So it's important you log all your statistics. Trading is not about getting winning trades, right? Anybody can have a winning trade. All you need to do is close your eyes, click buy, keep them closed, and then at some point, close your trade, right? You may have a winning trade, right? The key is to reduce your losing trades so that when you have a winning trade, instead of paying for drawdown, it's being used to compound your account. And the trading journal combined with the trading plan and the iterative procedure of improving the two will help with your winning and losing trades. Now, another tool I want to introduce you to is daily and weekly reviews. Now, with my mentoring, what I realized was at the end of the mentorship program, everybody understood exactly what a golden bullet was and what the entry criteria is. That is not the issue. What would typically happen is someone would learn the golden bullet strategy. The next day, they would send me a chart and they'd be like, Cam, I took this golden bullet trade, but it's stop lost. Could you please have a look at it? And I'll be like, yes. So this trade here, you have missed this key entry criteria. And the response is typically, yes, I know I missed the entry criteria, but I took the trade anyway. So the question is, if they know the entry criteria and they know that this particular trade did not fulfill the entry criteria, why did they take the trade? They took the trade because they do not trust that a golden bullet will present itself as a perfect trade with all of the entry criteria. Right? This is the mental barrier that you have to overcome. It's not about understanding what the entry criteria is for a golden bullet, but rather only waiting for a real golden bullet to present itself and then execute. Okay, the way we trade is as if we are walking down a street and on a corner we see $100 bill. If we see that $100 bill, we go down, we pick it up, and we go about our day. We are not bending over and picking up bits of newspaper or leaflets or anything else on the floor. We just wait for a $100 bill. That's what we pick up. Now, daily reviews will help you to trust the strategy. So this is what will happen. Let's say you take a golden bullet setup at 2 a.m. on Monday and you stop loss. And then you take another one at 2:30 a.m. and then you stop loss again. If you stop trading for the day and then come back at the end of the day and review those two trades, you may notice, because now you've got a fresh mind and you're not emotional in front of the charts, you may notice that you missed key entry criteria. So firstly, you are now providing evidence to yourself that if you take a golden bullet that doesn't fulfill entry criteria, it will likely stop loss. Now, this is the critical step. If you then review the price action for the rest of the day, you may see that a clean golden bullet with all the entry criteria presented itself at 3:30 a.m. New York time. And let's say another one was at the New York Open and another one was at the London close, let's say. Okay, now you are conditioning your mind and giving yourself evidence that clean golden bullets do present themselves. Then at some magical point in the future, you will come back to this exact same scenario where it's 2 a.m. on a Monday, you see this trade and you know it's not a real golden bullet because it's missing entry criteria, and you normally take it anyway, but this time you don't take the trade. You don't take the trade because, one, you remember from your reviews of your data and of your trades that if you take a golden bullet that misses entry criteria, it's likely to stop loss. And secondly, because you have been conducting reviews of daily price action, you will now trust that golden bullets, perfect, clean golden bullets, do present themselves very frequently. So you do not take this trade because, one, you know if it's not a golden bullet, it will probably be a losing trade. And two, you are patient enough to wait for a clean golden bullet because you trust that clean golden bullets do happen. This is why your daily and weekly reviews is key. It gets you from understanding what a golden bullet trade is to being patient and waiting for that golden bullet entry to present itself. Do not underestimate this. Now, trading is all about the incremental process of improving your trading performance. It's about increasing the number of winning trades that you take and reducing the number of losing trades that you take. Now, there's a great concept by Trader Tom where he talks about the playbook and the book of truths. If you go to the mindset chapter of this course, you will see a number of lectures from Trader Tom, or you can also purchase his book called The Best Loser Wins. Now, the two concepts that I would like you to use are the playbook and the book of truths. Once you have gone through this course and you understand what a golden bullet is, every clean golden bullet that you take and that you TP on, I want you to mark it up perfectly and save it to a separate document. Be it a Word document or a PowerPoint presentation, it doesn't matter. And any golden bullets that you see when you're backtesting the charts, I want you to mark it up as if you took the trade and you TP'd on the trade and also put it into your playbook. Now, how do I use my playbook? Before every trading session, I look through my playbook to remind myself and to focus my mind on exactly what I am looking for in terms of entry criteria. It's very similar to when you have a hunting dog and you provide the hunting dog with scent of its prey before it goes to hunt. You are focusing the mind on exactly what you're looking for. Whenever we sit down in front of the charts, we are essentially trying to solve a puzzle. We are trying to pass an exam. Your playbook is the answers to your exam. It is the cheat sheet. So while you're trading, if you see the candles forming and you are not sure of the setup, all you have to do is look into your playbook. And if the candles that are forming matches any of your trades in your playbook, you know it's probably a good trade. right? Do not underestimate the playbook. Within this server, I have my own playbook there. So you will see dozens of trades that I've taken. So you can start understanding the variations of a golden bullet. Now, the second concept that is very powerful from Trader Tom's work is called the Book of Truths. These are all the trades that I have taken that I never want to take again, right? So I'm not saying if you take an A+ setup and it's stop losses, you put it in your Book of Truths. That goes into your trade journal. These are all the trades I never want to take again. So let's say we go back to our example where you're still in that phase where you're taking golden bullet setups that doesn't fulfill a certain entry criteria. You want to put that example of that stop loss trade into your Book of Truths. So then when you look at your Book of Truths before your trading session, you are reminding yourself of all the trades that you do not want to take. And then also when the candles are forming during a live trading session, if you are unsure, all you have to do is look at your Book of Truths and you know whether you should take this trade or not. Right? The playbook is all about increasing the chances of you taking winning trades, and the Book of Truths should reduce the number of losing trades that you take. Over time, you will find edge conditions of the golden bullet that only experience will give you. These edge conditions go into your playbook and your Book of Truths. They may be edge conditions where it doesn't quite look like a classic golden bullet, but you know it's one that you should take. So you put it into your playbook. And secondly, you'll have edge conditions where it may look like a golden bullet, but it's not. That goes in your Book of Truths. Something I remind my mentorship students, whenever you take a golden bullet trade, you have to think, the candles that are forming and presenting themselves, are they a reflection of the golden bullet algorithm? Or is it more likely that they are random candle formations that could be interpreted as a golden bullet? Right? This is the experience of trading. Once you know the golden bullet setup, you have to differentiate between random candles making it look like a golden bullet and real golden bullet plays. Log this in your playbook and your Book of Truths. Later in this course, I will show you some trades from the playbook and the Book of Truths to help you to understand how you can use these aspects and these tools. In this teaching, I'm going to be going through some key aspects of risk management when it comes to the golden bullet strategy. Now, by no means is this video intended to be a complete overview of every risk management strategy you should have as a trader, but I wanted to call out 3 specific strategies that we need to adopt for the golden bullet setup. Now, the first strategy I call the Vegas strategy. So back in the day, when I was a banker, I used to go to Vegas every year just for some entertainment. Now, roulette was my game, and if you know anything about roulette, it's purely a game of chance. There's no skill involved whatsoever. And I know over the long run, the house has an edge, and the house will end up winning, and I will end up losing. But I had one simple strategy. As soon as I had a really big win, I would cash in my chips, and I would stop gambling for the rest of the vacation. Reason being is once I'm up, if I no longer gamble, I'm guaranteed to be up for the trip. Even though the odds are against me and I'm supposed to be down, if I consistently gamble during this Vegas trip, as long as I cash in my chips when I'm up, I'm guaranteed to win. Now, I use this strategy with the golden bullet also. And it's very simple. As soon as I have my first win of the day, once the trade hits TP, I close my charts and I'm done for the day. In this way, we are guaranteed to be up for the day, and we are one step closer to passing a funded challenge or getting a payout on a funded account or paying off a mortgage or whatever your goal is. As humans, we have a tendency to trade emotionally. And sometimes when you have that win, you chase another win. And then yes, you may get your second win, and then you may go for a third. But what usually ends up happening is as you accumulate wins during the day, you become more lax in your entry criteria, or you become inventive with the trades that you take. So as the day goes by, emotionally you become a worse trader. So by stopping trading after your first win, you prevent yourself from overtrading. The second reason why I like the Vegas strategy is the market will only present you with a limited number of high probability setups per day. And I find that these are during key times anyway. So my high probability golden bullet plays are, within the London Open kill zone, or within a time macro window, or at the New York Open, or at the London close, so very specific times. Once your trade hits TP for the golden bullet, you essentially have less wins left on the table. So why risk taking another trade when it's less likely that you will TP again? There are only a limited number of good trades in a day. The other reason I really like the Vegas strategy is ultimately trading is about giving us freedom to not have to work a 9 to 5. And what I find a lot of people tend to do is after a winning trade, they will still continue to sit there on the charts all day looking for more and more wins, when ultimately it's about freedom. Get your first win of the day, close your charts, and then use the rest of the day for your other goals that you have in life or to enjoy life. Don't become a slave to the charts. Use the Vegas strategy to make it a winning day. You're then one step closer to your ultimate goal, and then go enjoy the rest of the day. The second strategy I call the don't get run over strategy. Now, as adults, we can cross a road and it's highly unlikely that we're going to get run over. But if we stand in the middle of the road all day, or if we keep going back and forth, as we get more complacent, as we get mentally tired, as we just spend more time in a dangerous place, the risk of getting hit by a car increases. Now, I treat the markets the same way. If, for whatever reason, I hit 2 losses in a day, I close my charts and I'm done trading for the day. Now, there are 3 reasons for this. The first reason is, it doesn't matter what your strategy is, the markets may be running a certain algorithm that is not conducive to your strategy. Now, the classic case of this is the seek and destroy algorithm that sometimes runs across sessions or runs for an entire day. It doesn't matter what your strategy is, a seek and destroy will probably wipe you out. And if you keep trying to enter during a seek and destroy, you can burn your account very, very easily. Now, the problem with a seek and destroy day is you don't really know it's occurring until it's too late, right? It may take you 3 or 4 losses to finally realize it's a seek and destroy day. If you stop trading at your second loss, you have preempted those extra losses, that extra cost of losses it will take you to discover it's a seek and destroy day. The second reason why I like this 2 max loss rule is, yes, the markets may be presenting good, clean golden bullet setups today, but maybe emotionally you are just not there today. Maybe you didn't sleep so well, so your decision-making process isn't quite on point today. Maybe you've had a stressful morning, so you're tending to FOMO or revenge trade. Maybe you aren't patient enough today and you're just not waiting for entry criteria, or maybe you're just taking inventive trades that aren't really golden bullets. To protect yourself from yourself, this 2 max loss rule really, really can be the difference between denting your account and destroying your account. So 2 main reasons. 1, the markets may not be conducive to your strategy. And 2, the second reason, your mindset may not be conducive to the market today. Now, the third reason why I like the don't get run over rule is, let's say you come in on a Monday and it's London Open kill zone and you take a trade at 2 a.m. straight away and you lose. And then you take another trade at 2:20 a.m. and you lose again. If you then close the charts and you're down 2R and come in on Tuesday and then hit your winning trade and you close your charts again, you are now at break even coming into Wednesday. So you are mentally clean and flat, and you are not carrying any emotional baggage to that trading day. This is the great benefit of having a strategy where the RR is 2. Now, let's say on the Monday you take your 2 losses, and instead of closing your charts, you take another trade and you lose again. You are at a major inflection point. So let's say, best case scenario, you close your charts at 3 losses and you come in on Tuesday and you win your trade and close your charts. Going into Wednesday, you are still down 1R. You had 3 losses on Monday, you had a win of 2R on Tuesday, and now you're down 1R on Wednesday. So you're still under pressure to perform, which can affect you. But if you had just taken your 2 losses on a Monday, you had your win on Tuesday, you'll be flat by Wednesday. Now, let's say on the Monday you take your 3 losses, but then take another trade in order to try to gain back that lost capital. You are now at risk of a downward spiral where suddenly 3 losses or 4 losses can turn into 5 losses or a blown account. Right, this is why that 2 max loss rule is super important. Now, the third strategy I really like, and it took me a while to understand this, and it might be a little bit controversial, but I think it's the right thing to do when you're trading a single strategy, is keep your risk per trade constant, no matter what. So what I used to do in previous strategies was, I would say, let's say, okay, I'm only going to risk 1% per trade. And then after 2 losses, I'd be down 2%. And then I would say, all right, I'm going to reduce my risk to 0.5%, right? Because I'm kind of scared now that I'll lose again. If after reducing the risk to 0.5%, you then win, you've gained 1R. So instead, if you had kept your risk the same, you'd now be break even. Now, instead of being flat because you only risked 0.5% instead of 1%, you are now still down 1R. And then you may say, okay, I'm going to increase my risk again. And let's say you increase your risk and you're up, X%. If you then take a loss and then reduce your risk again, what you're essentially doing is you're allowing your losing trades to be a full 1R loss. But then if you hit a winner after your loser, just because you've reduced the risk, your winning trades end up paying you less, and your winning trades don't pay for your losses. This is why I always keep my risk constant. Now, how do I approach funded challenges? Let's say you're on an old school style funded challenge where there's a 10% target and a 10% max drawdown. I like to have at least 20 trades that I can use for a funded challenge, right? This didn't work in the old days when you had 30 days to pass a challenge because you just didn't have enough high quality trades you could take in those 30 days. Now, if you give yourself 20 trades to pass a challenge by only risking 0.5% per trade, what that means is even if you lose, 3 or 4 trades in a row, you still shouldn't be at that emotional danger zone where you start trading out of fear to execute and pull the trigger, or you start taking FOMO trades, hoping that you would get lucky and pass a challenge or get out of drawdown. So having that 20 trade buffer really, really helps. Yes, you have to be patient, because if you're only risking 0.5% to pass a 10% challenge, you're not going to pass it in a couple of weeks. It'll probably take you a good, 3 weeks at least to pass it. Now, it all depends upon your win rate, obviously, but it just means you're under no pressure during periods of consistent losses, because you will have those consistent losses. It doesn't matter how good your system is. The way random numbers and random number events work is sometimes you just get a string of losses. Now, if you are risking 1% per trade and you suddenly have 4 or 5 losses, you're down 50% in your account. That can really affect you emotionally. But if you're only risking 0.5%, it's not so bad. You can deal with it because you have plenty of bullets in the chamber left to pass that challenge. So summarize: risk per trade, keep it constant. Don't vary it depending upon if you're on a losing streak or a winning streak, because then when you're in a losing streak and you do get a winner, that winner won't pay for the losses. And then always give yourself plenty of trades to pass a challenge. I'm going to be uploading a lot more teachings on risk management, but I wanted to cover these 3 main tenets that I think are key when adopting the golden bullet strategy. In this teaching, I'm going to be going over the prerequisites that we have to adhere to before we execute any golden bullet setup. Now, when I was experimenting with the golden bullet and trying to refine it and trying to increase my win rate, the key difference maker for me was including the ICT confluences as part of my golden bullet entry strategy to really get to that consistently profitable status. Now, when I first started trading GoldBach, I was kind of ignoring all other teaching I remembered from my ICT learning, and I was just focusing on those GoldBach levels. But it's only once you include these ICT confluences do you take your golden bullet trading to the next level. Now, there are 3 mandatory ICT principles that we must adhere to before we execute that golden bullet. So the first one is the daily bias. We only ever execute trades if it aligns with our daily bias. Now, how do we formulate our daily bias? Our daily bias really comes from doing our analysis of the DXY on a higher time frame, and we are really trying to estimate whether next week's candle will close bullish or bearish. So using ICT principles on the higher time frame, we're trying to ascertain whether next week's candle will close bullish or bearish. Now, it's not enough to know, let's say, that next week we expect a bullish candle. We can't take longs every single day next week. We have to pick the days in which we want to trade to find those high probability bullish setups. So as you know, every candle, including the weekly candle, opens. It has the element of a Judas swing, which is the wick, and that Judas swing will be away from your intended weekly bias. So if we're bullish for next week, that Judas swing will typically be bearish, and it may have an element of consolidation. Once we've formed that low of the week, we then expand, and it's only after we think that low of the week is in place do we look for our longs. Once we think the high of the week has been put in place, we stop trading, because then we expect the retrace and the opposite wick of that candle to be created. Now, in short, the way we determine the low and high of the week is to marry our weekly bias with the economic calendar. And we're trying to sieve out where we think the low and high of the week will form based off of the high impact news events. Right, so I will do a longer teaching on this. But the answer to this question really comes from analyzing those weekly DXY bias videos that I produce. And so don't just watch the one that is pertinent to your next week's trading. Try to watch the history of them also, so you can start understanding for yourself how I formulate the daily bias and then the weekly bias. Now, yeah, so that's the first one. We only take golden bullet trades that align with our daily bias. Right, before we take any golden bullet trade, we have to have a sweep of liquidity. And that sweep of liquidity has to at least be an M5 sweep. Now, ICT himself recently said that his son's algorithm relies on a sweep of liquidity before he enters. And he also said higher time frame algorithms also have a slight retrace and a sweep. So we never take golden bullet setups unless there's been a sweep of liquidity. Now, the third mandatory requirement is there has to be a draw on liquidity in line with the golden bullet entry and the draw and the daily bias. Reason being, there's no point taking a golden bullet trade that aligns with your daily bias, but price does not have a reason to go there. So the draw on liquidity could be equal highs, equal lows. It could be prior day highs, prior day lows, session liquidity, H4 or H1 liquidity. But there has to be a reason for price to want to get there as part of the golden bullet algorithm. But of course, we don't necessarily TP at that draw on liquidity. We TP where the golden bullet is supposed to TP, and that's in a later teaching, but there has to be a draw on liquidity. So the three mandatory ICT confluences, once again, is we only take trades that align with our daily bias. We need a sweep of liquidity before we enter our golden bullet trade, and there has to be a logical draw on liquidity. Now, there are other confluences also, so we should be mindful of AMD. So we spoke about the weekly candle having an element of a Judas swing, accumulation, manipulation, distribution. So typically I don't trade Mondays because would be the accumulation, and I don't trade Fridays because that's usually the other side of the wick, which is the consolidation. I trade London open kill zone primarily, so I am always looking at Asia, the session prior to London, to understand what did Asia do and what was its role in AMD. Ideally, I'm looking for Asia to be the accumulation or the consolidation, because then it's likely that London will manipulate and distribute, giving us enough volatility for us to TP our golden bullet. However, if Asia has already expanded, I will not trade London because London will probably consolidate, and I would look to trade New York. You can use the same logic if you trade New York. You just have a look at London. If London has expanded massively, then maybe your New York session will consolidate. So bear that in mind. Trading is really about filtering away and removing and reducing as many losing and low probability trades as you can, so that your winners, instead of getting you out of drawdown, they are growing your account. Now, there are 3 indicators I also like for additional confluence. One is the ICT everything indicator. And this indicator allows you to project the high or low of the day using standard deviations of the CBDR, Asia range, and the flout. Now, it's just handy to know where a potential high or low of the day could occur, because that may tell you where the Judas swing is. So if you see a golden bullet entry at what may be the low of the day, according to the ICT everything indicator, that is fantastic confluence. I also use DMN's ICT toolkit to be aware of the average daily range. Reason being, let's say EU on average moves 80 pips a day. If price has already moved 85 pips and I see a golden bullet entry that requires me to get to, let's say, 95 pips to TP, I will not take that, because price is already extended and has exceeded its average daily range. So it's less probable that it will push further for me to TP. Knowing the average daily range is usually more important for New York traders. However, London traders should be aware of it also, just in case Asia did a big move. The final indicator that I really love using for extra ICT confluence is the ICT macros indicator. Now, this indicator paints on your charts the 20-minute windows which ICT spoke about, and during these 20-minute windows, a macro may run which will move price in order to address an imbalance or sweep liquidity. Now, if you're aware of these timings and you start taking golden bullet trades and you see a golden bullet aligning with one of these macro windows, that is great confluence. And as you become more aware of these windows and you see more golden bullet executions aligning with these windows, you have a greater confidence in taking the trade. So 3 indicators that may help you with your trading. The ones I use more heavily are the ADR. I'm always aware of where we are in terms of the daily range. I know the macro timings now, so I might not necessarily use the indicator. And I like being aware of the high of the day or the low of the day projections. But the key thing about this teaching is we do not take any trades unless it aligns with our daily bias, there's been a sweep of liquidity, and the golden bullet entry will move towards a logical drawn liquidity.